If you are over 65 and worried about your financial future, I need you to listen carefully to what I am about to share. Because after 50 years of managing money through every market condition imaginable, I have distilled retirement success down to 4 essential steps. 4 steps that, if followed, will give you the best chance of financial security for the rest of your life. This is not complicated. It does not require sophisticated financial knowledge. It does not demand constant attention or difficult decisions. But it does require understanding some fundamental truths about money, risk, and time that most people never grasp. Let me start with a story that will set the stage for everything that follows. In 2008, I watched the financial world come apart. Lehman Brothers collapsed. The stock market fell by more than 50%. Retirement accounts were devastated. People who thought they were secure suddenly faced the prospect of running out of money. I remember meeting with a couple in their late 60s that year. They had worked their entire lives, saved diligently, and accumulated what seemed like a comfortable nest egg. They had retired just 2 years earlier, confident that their portfolio would support them for the rest of their lives. Then the crash came. Their portfolio dropped by 40%. They panicked and sold near the bottom, locking in losses. They went from feeling financially secure to lying awake at night, wondering if they would have to go back to work in their 70s. Their mistake was not that they owned stocks. Their mistake was that they had no plan. They had accumulated assets but never thought carefully about how to convert those assets into sustainable income. They had no framework for making decisions under stress. When the crisis hit, they acted on emotion rather than principle. I think about that couple often because their story illustrates something fundamental about retirement success. It is not just about how much money you have accumulated. It is about having a plan that can withstand whatever markets throw at you. The 4-step plan I am going to share with you today is designed to prevent what happened to that couple from happening to you. It is designed to provide financial security regardless of market conditions. It is designed to let you sleep at night knowing that your retirement is protected. Let me give you an overview of the 4 steps before we dive deep into each one. Step 1 is to calculate your true income need. Not what you think you need, not what a financial calculator tells you. Your actual, realistic income requirement based on how you actually live. Step 2 is to build your income floor. This is the foundation of your retirement security, the guaranteed income that covers your essential expenses no matter what happens in markets. Step 3 is to structure your investment portfolio for sustainability, not for maximum returns, not for excitement, for sustainable income that can last 30 years or more. Step 4 is to create your decision framework, the rules you will follow when markets get volatile, when you face unexpected expenses, when life throws you curveballs. These 4 steps work together as a system. Each one reinforces the others. Skip any one of them, and the entire plan is weakened. Follow all 4, and you have a robust framework for retirement success. Let me take you through each step in detail. Step 1, calculate your true income need. This sounds simple, but almost everyone gets it wrong. They either dramatically overestimate what they need, which causes unnecessary anxiety and excessive frugality, or they underestimate what they need, which leads to spending down assets too quickly. The key is specificity. You need to know exactly what you spend. Not roughly, not approximately, but exactly. Start by tracking your actual spending for at least 3 months, preferably 6. Look at your bank statements, credit card bills, and cash withdrawals. Categorize every dollar: rent or mortgage, utilities, food, transportation, healthcare, insurance, entertainment, travel, gifts, everything. Most people are shocked by what this exercise reveals. They think they spend one amount, and the reality is quite different. Often it is higher than they thought. Sometimes it is lower. Either way, knowing the truth is essential. Once you know what you actually spend, divide your expenses into 2 categories: essential and discretionary. Essential expenses are the costs you must pay regardless of circumstances. Housing, whether rent or mortgage, plus property taxes and insurance, utilities, basic food, healthcare, including insurance premiums, medications, and routine care. Transportation to get to medical appointments and buy necessities. Basic insurance. Discretionary expenses are everything else: travel, entertainment, dining out, gifts, hobbies, the things that make life enjoyable, but that you could reduce or eliminate if necessary. This distinction is crucial because your income floor in Step 2 needs to cover your essential expenses completely. Discretionary expenses can be funded from investment income that may vary year to year. For most retirees over 65, Essential expenses run somewhere between $3,000 and $6,000 per month, depending on location, housing situation, and health status. Your number may be higher or lower. The important thing is that you know your number precisely. Also consider how your expenses will change over time. Early retirement, say 65 to 75, often involves higher discretionary spending on travel and activities, while health permits. Middle retirement, 75 to 85, typically sees reduced activity and lower discretionary spending. Late retirement, 85 and beyond, may involve increased healthcare costs that offset other reductions. Build these changing needs into your calculations. A common rule of thumb is that spending decreases by about 1% per year in real terms during retirement, but your personal pattern may differ. Finally, build in a buffer for unexpected expenses, healthcare emergencies, home repairs, family needs, inflation surprises. I suggest adding 10 to 15% to your calculated essential expenses as a safety margin. The result of this step is a clear number, the monthly or annual income you need to cover essentials, plus a safety buffer. This number drives everything else in your retirement plan. Step 2, build your income floor. The income floor is the most important concept in retirement planning. It is the guaranteed income that covers your essential expenses regardless of what happens in financial markets. When your income floor fully covers your essentials, you have true financial security. Markets can crash. The economy can enter recession. Your investment portfolio can decline by 30 or 40%. And you will still have enough income to pay your bills and maintain your basic standard of living. The income floor consists of guaranteed or highly reliable income sources. First and most important for most Americans is Social Security. If you have not yet claimed Social Security, understand that delaying your claim increases your benefit by approximately 8% per year between age 62 and 70. That is a guaranteed return that is very difficult to match elsewhere. For someone who would receive $2,000 per month at 62, delaying to 70 increases the benefit to approximately $3,550 per month. That is over $18,000 more per year for life, plus inflation adjustments. Unless you have health issues that suggest a shorter than average lifespan, delaying Social Security is usually the right choice. If you are already collecting Social Security, you know your benefit amount. This is the foundation of your income floor. Second, if you are fortunate enough to have a pension from a former employer, this adds another reliable income stream. Traditional pensions are increasingly rare, but if you have one, it provides guaranteed income for life. Third, you can create additional guaranteed income through immediate annuities. An immediate annuity is a contract with an insurance company where you give them a lump sum and they pay you a fixed amount monthly for life. I know annuities have a bad reputation in some circles, and some annuity products are indeed expensive and complicated. But a simple immediate annuity from a highly rated insurer can play a valuable role in building your income floor. For example, a 65-year-old might pay $100,000 for an immediate annuity that pays approximately $600 per month for life. That is income that continues regardless of market conditions, regardless of how long you live. The appropriate amount to allocate to annuities depends on your situation. If Social Security and pension cover most of your essential expenses, you may not need any. If you have a significant gap between guaranteed income and essential expenses, annuities can fill that gap. Fourth, the income floor can include Treasury bonds and Treasury inflation-protected securities held to maturity. These are not technically guaranteed like Social Security or annuities, but they are backed by the U.S. government and provide predictable income if held to maturity. The goal of Step 2 is to ensure that your income floor, the sum of Social Security, pension, annuities, and safe bonds, equals or exceeds your essential expenses plus your safety buffer. When this is accomplished, you have created true security. Your basic needs are covered no matter what. Markets become less scary because your survival does not depend on them. You can weather volatility without panic. Let me give you a concrete example. Say your essential expenses plus buffer total $5,000 per month. Your Social Security is $2,500. You have a small pension of $500 together. That is $3,000 per month in guaranteed income. You have a $2,000 gap. You could fill this gap by purchasing an annuity for approximately $330,000 that pays $2,000 per month for life. Or you could fill it with a ladder of treasury bonds that mature over the next 15 to 20 years, providing predictable income. Either way. Once the gap is filled, your income floor equals your essential needs. You have security. Step 3. Structure your investment portfolio for sustainability. Once your income floor covers your essentials, you have flexibility with the rest of your portfolio. This is the money that funds discretionary spending, provides a reserve for unexpected expenses, and potentially grows to leave a legacy. The key word is sustainability. Your portfolio needs to generate income and potentially grow over a period that could easily be 25 to 30 years. Even at 65, planning for a 30-year retirement is prudent. People are living longer. Running out of money at 90 is a very real risk. Sustainability requires balancing 3 objectives: income generation to fund current discretionary spending, growth to maintain purchasing power against inflation, preservation to avoid catastrophic losses that impair future income. These objectives are in tension with each other. Assets that generate high current income often have limited growth potential. Assets with high growth potential often generate little income and can be volatile. Finding the right balance is the art of retirement portfolio management. Here is the framework I recommend. Divide your investment portfolio, the assets not dedicated to your income floor, into 3 buckets. Bucket 1 is the liquidity reserve. This is 2 to 3 years of discretionary spending held in cash equivalents, money market funds, short-term treasury bills, high-yield savings accounts. This money is not meant to grow. It is meant to be available. The liquidity reserve serves 2 purposes. It provides funds for discretionary spending without requiring you to sell investments, and it provides a buffer during market downturns. When stocks fall, you draw from the liquidity reserve rather than selling depreciated shares. Bucket 2 is the income portfolio. This is designed to generate sustainable income while providing modest growth. It consists of intermediate-term investment-grade bonds, dividend-paying stocks of the highest quality, and potentially some alternative income sources like REITs. The allocation within Bucket 2 depends on your risk tolerance and income needs. A conservative approach might be 60% bonds, 40% dividend stocks. A more aggressive approach might reverse that. For bonds, focus on investment-grade corporates with maturities of 3 to 7 years. These provide meaningful yield with manageable interest rate risk. For dividend stocks, focus on quality above yield. Companies with long histories of dividend growth, conservative payout ratios, strong balance sheets, and durable competitive advantages. The dividend aristocrats. Companies that have raised dividends for at least 25 consecutive years are a good starting universe. The target income from Bucket 2 might be 3 to 4% annually. This is sustainable without depleting principal. Bucket 3 is the growth portfolio. This is invested primarily in diversified stock index funds for long-term growth. It provides the inflation protection and potential legacy building that pure income investments cannot match. Bucket 3 is the riskiest part of the portfolio. It will fluctuate significantly with markets. But because your essentials are covered by the income floor and your near-term discretionary needs are covered by Buckets 1 and 2, you can afford to let Bucket 3 ride through market cycles. The allocation across buckets depends on your situation. A retiree with a strong income floor and modest discretionary needs might have smaller liquidity reserve and income portfolio, with more in growth. A retiree with higher discretionary spending or a weaker income floor might need larger allocations to the first 2 buckets. A reasonable starting point for many retirees might be 15% in the liquidity reserve, 40% in the income portfolio, and 45% in the growth portfolio. Adjust based on your specific circumstances. The key is that the 3 buckets work together. The liquidity reserve provides stability and flexibility. The income portfolio generates sustainable cash flow. The growth portfolio maintains purchasing power over the long term. Rebalancing annually maintains your target allocations. When stocks have risen, you trim growth and refill the liquidity reserve. When stocks have fallen, you may delay rebalancing to avoid selling at depressed prices, drawing from the liquidity reserve instead. Step 4. Create your decision framework. This might be the most important step of all, because the best plan in the world is worthless if you abandon it when markets get scary. A decision framework is a set of predetermined rules that guide your actions during both normal times and crises. It removes emotion from the equation. It prevents panic selling. It ensures consistency. Your decision framework should address several scenarios. Scenario 1. Markets decline significantly. Say stocks drop 25% or more. Your predetermined response should be to do nothing with your growth portfolio. Continue drawing from your liquidity reserve for discretionary expenses. Do not sell stocks at depressed prices. If your liquidity reserve gets low, reduce discretionary spending rather than selling depreciated assets. The framework might say something like, if stocks decline more than 20%, I will reduce discretionary spending by 20% and draw exclusively from the liquidity reserve until markets recover. Scenario 2. Markets rise significantly. Say stocks gain 25% or more in a year. Your predetermined response should be to rebalance, trimming stocks and refilling the liquidity reserve and income portfolio. Take some gains off the table. Restore your target allocations. The framework might say, at the end of each year, if my growth portfolio exceeds its target allocation by more than 5 percentage points, I will rebalance to targets, moving the excess into the liquidity reserve. Scenario 3. Unexpected major expense. A healthcare crisis, home repair, family emergency. Your predetermined response depends on the size of the expense. Small expenses come from the liquidity reserve. Large expenses might require selling from the income portfolio. Only in extreme circumstances should you touch the growth portfolio. The framework might say, unexpected expenses up to $10,000 come from the liquidity reserve. Expenses of $10,000 to $50,000 come from selling income portfolio holdings in a tax-efficient manner. Only expenses exceeding $50,000 would require touching the growth portfolio. Scenario 4. Inflation spikes significantly. Say inflation runs above 5% for an extended period. Your predetermined response should be to maintain your growth allocation, which provides inflation protection, and to review your essential expense calculations. Social Security provides inflation adjustments. Your dividend stocks should increase their payouts over time, but you may need to reduce discretionary spending if real purchasing power is eroding. Scenario 5. You live longer than expected. You reach 85 or 90 and realize you might live another 10 years. Your predetermined response should be to gradually shift more conservative if your portfolio has grown sufficiently, or to reduce discretionary spending if it has not. The income floor continues to provide security regardless. The framework might say, at age 85, I will review my portfolio and spending. If my portfolio exceeds my original retirement amount, I will shift 5 percentage points from growth to income. If my portfolio has declined, I will reduce discretionary spending by 10%. Writing down these frameworks and committing to them in advance is essential. During a crisis, your emotions will scream at you to do something. Having a predetermined response gives you something to follow other than panic. Share your framework with your spouse or partner if you have one. Discuss it with your financial advisor if you use one. Make sure everyone who might be involved in financial decisions understands and commits to the framework. Now let me discuss how these 4 steps work together as an integrated system. The income floor provides security. Because your essentials are covered by guaranteed income, you can weather market volatility without fear. This security enables you to take appropriate investment risk with the rest of your portfolio. The investment portfolio structure balances multiple objectives. The liquidity reserve provides stability and flexibility. The income portfolio generates sustainable cash flow. The growth portfolio maintains purchasing power over the long term. The decision framework prevents emotional mistakes. By predetermining your responses to various scenarios, you avoid the panic selling and performance chasing that destroys most retirement portfolios. And it all starts with knowing your true income need. Without this foundation, everything else is guesswork. The 4 steps reinforce each other. If your income floor is strong, you need less from your investment portfolio and can be more aggressive with growth. If your portfolio is well structured, you can follow your decision framework with confidence. If you follow your framework, your portfolio remains positioned for long-term success. Neglecting any step weakens the entire system. A weak income floor creates anxiety that leads to poor decisions. A poorly structured portfolio cannot sustain 30 years of withdrawals. Without a decision framework, emotional mistakes are almost inevitable. Let me address some common questions and objections. What if I do not have enough assets to build a proper income floor? This is a real challenge for many retirees. If Social Security alone does not cover your essential expenses, and you do not have sufficient assets to fill the gap with annuities or bonds, you have difficult choices. First, re-examine your essential expenses. Are there ways to reduce them? Could you move to a lower cost area? Could you downsize your housing? Could you find cheaper transportation? Second, consider part-time work. Even modest income from part-time work can fill a gap in your income floor. Working 10 to 15 hours per week at a modest wage generates meaningful additional income. Third, consider delaying retirement if possible. Every year you delay allows your Social Security benefit to grow and your portfolio to compound. Fourth, if you must retire with an inadequate income floor, structure your portfolio very conservatively and plan to reduce discretionary spending significantly during market downturns. What about healthcare costs? Healthcare is a major uncertainty in retirement. Medicare covers much but not all. Long-term care is extremely expensive and not covered by Medicare. My recommendation is to include Medicare premiums and estimated out-of-pocket costs in your essential expenses calculation for long-term care. You have three options. Self-insure by maintaining a larger portfolio. Purchase long-term care insurance, which is expensive but provides protection, or plan to rely on Medicaid, which requires spending down assets. There is no perfect answer here. Long-term care insurance makes sense for some people but not others. Consider your family health history, your risk tolerance, and your assets. What about leaving money to heirs? This is a personal decision. Some retirees prioritize leaving a legacy. Others plan to spend everything and leave nothing. My four-step plan is agnostic on this question. If leaving a legacy is important, you might allocate more to the growth portfolio and less to current spending. If spending everything is your goal, you might allocate more to the income portfolio and spend more freely. What matters is that your plan is sustainable for your lifetime. Running out of money while alive is a much worse outcome than leaving less to heirs. What about taxes? Tax efficiency matters, especially for portfolios with significant size. The general principles are to hold tax-inefficient investments, like bonds and tax-advantaged accounts, like IRAs and 401ks, to hold tax-efficient investments like index funds in taxable accounts, to draw from accounts in a tax-efficient sequence, usually taxable first, then tax-deferred. Then Roth tax planning can add meaningful value over a long retirement. Consider working with a tax professional to optimize your approach. Let me share some implementation guidance for putting this plan into action. Start with step 1 immediately. Track your spending for the next 3 to 6 months to understand your true income need. This costs nothing and requires only attention. Once you know your true income need, calculate your income floor gap, compare your guaranteed income sources to your essential expenses. The gap is what needs to be filled. Consider your options for filling the gap: annuities, treasury ladders, or simply accepting that you will need to draw from your investment portfolio for essentials. Each approach has trade-offs. Structure your investment portfolio according to the 3-bucket approach. This may require selling some positions and buying others. Do it thoughtfully, considering tax implications. Write down your decision framework. Literally write it down. Make it specific. Share it with anyone who needs to know. Review your plan annually. Recalculate your income need. Check your income floor. Rebalance your portfolio. Update your decision framework if circumstances have changed. This is not a one-time exercise. Retirement planning is ongoing. Your situation will change, markets will change, tax laws will change. Regular review keeps your plan current. Let me close with some thoughts on the psychology of retirement success. Money is emotional. Retirement is emotional. Combining the two creates enormous potential for anxiety, fear, and poor decisions. The 4-step plan I have shared is designed not just to provide financial security, but to provide psychological security. When you know your income floor covers your essentials, you worry less. When your portfolio is structured for sustainability, you sleep better. When you have a decision framework, you feel more in control. This psychological benefit is as important as the financial benefit. Retirement should be enjoyed, not endured. Financial anxiety robs you of the joy your retirement years should bring. The couple I mentioned at the beginning of this discussion, the ones who panicked in 2008, they did not have a plan. They had assets, but no framework. When crisis hit, they had no predetermined response to fall back on. They acted on fear rather than principle. You can be different. You can have a plan that provides both financial and psychological security. You can face market volatility with equanimity rather than panic. You can enjoy your retirement knowing that your finances are structured for sustainability. The 4 steps are simple. Calculate your true income need, build your income floor, structure your investment portfolio for sustainability, create your decision framework. Simple does not mean easy. Implementing these steps requires effort, attention, and sometimes difficult decisions. But the effort is worth it. The security these steps provide is priceless. You have worked your entire life to reach this point. You deserve a retirement that is secure, comfortable, and enjoyable. The 4-step plan can help you achieve that. Start today, calculate your income need, begin building your income floor, structure your portfolio wisely. Commit to a decision framework. Your future self will thank you. Let me go deeper on each of these steps, because the details matter when you are implementing with real money. On step 1, calculating your true income need, I want to emphasize the importance of honesty with yourself. Most people have blind spots about their spending. They forget the annual expenses that do not show up monthly. Property taxes paid twice a year, insurance premiums paid quarterly, holiday spending that spikes in November and December, vacation costs, home maintenance. A complete spending analysis captures all of these. Look at a full 12 months of bank and credit card statements. Categorize everything. The result might surprise you. I also want to address the question of inflation adjustment. Your income need today will be higher in 10 years and higher still in 20 years. Planning only for current expenses is a mistake that catches up with you over time. A useful approach is to calculate your income need in today's dollars. Then assume 3% annual inflation. At 3% inflation, prices roughly double every 24 years. Your $5,000 monthly essential expense becomes $10,000 in today's dollars by your mid-80s. Your income floor needs to keep pace with inflation. Social Security has automatic cost of living adjustments. Annuities typically do not unless you pay extra for an inflation rider. This is an important consideration when structuring your income floor. On step 2, building your income floor. Let me expand on the annuity discussion because this is an area of significant confusion. There are many types of annuities. Immediate annuities, deferred annuities, fixed annuities, variable annuities, indexed annuities. Some are simple and useful. Others are complex and expensive. For retirement income purposes, I focus on immediate fixed annuities. You pay a lump sum, you receive fixed monthly payments for life, simple, transparent. No hidden fees or complex features. The payment you receive depends on your age, current interest rates, and whether you want payments for your life only or for both you and a spouse. Joint life annuities pay less per month, but continue until both spouses have passed. The main objection to annuities is that you lose control of your money. If you die shortly after purchasing the annuity, the insurance company keeps the balance. This bothers many people. There are several responses to this concern. First, you can purchase an annuity with a period certain, meaning payments continue to your heirs for a minimum period like 10 or 20 years. This provides some protection against early death but reduces the monthly payment. Second, you should only annuitize the portion of your assets needed to fill your income floor gap. The rest remains in your investment portfolio under your control. Third, consider the annuity as insurance rather than investment. You are not trying to maximize returns. You are paying to eliminate the risk of outliving your money. Insurance costs money. That is the nature of insurance. Fourth, if you are married, the annuity can be structured as joint life. You both receive income for as long as either of you lives. This provides valuable protection, especially for the surviving spouse. The decision about how much to annuitize is personal. It depends on your other income sources, your health, your family longevity history, and your psychological comfort with giving up control of assets. My general guidance is that annuitizing enough to fill your income floor gap makes sense for many retirees. Beyond that, keep assets in your investment portfolio where you maintain control and flexibility. On step 3, structuring your investment portfolio, let me provide more detail on each of the 3 buckets. The liquidity reserve, bucket 1, should be in instruments that maintain stable value and provide immediate access. Money market funds are ideal. They pay current short-term rates, typically around 4 to 5% currently, with no price fluctuation. You can withdraw at any time. High-yield savings accounts are another option. They are FDIC insured up to $250,000 per depositor per bank. They pay competitive rates, often comparable to money market funds, short-term treasury bills, with maturities under 1 year also work. They are backed by the U.S. government and can be sold at any time with minimal price impact. What does not belong in the liquidity reserve? is anything with meaningful price risk. Bond funds can decline when interest rates rise. Stock funds obviously fluctuate. Even intermediate bonds have price risk. The liquidity reserve is not meant to earn high returns. It is meant to be available when you need it without risk of loss. The income portfolio, bucket 2, is where you balance yield, growth potential, and risk. For the bond portion, I recommend individual bonds held to maturity. If your portfolio is large enough, or low-cost bond funds, if it is not individual bonds, have the advantage of predictable income and return of principal at maturity. Bond funds provide diversification but fluctuate in price. Focus on investment-grade corporate bonds. These are bonds rated BBB or higher by Standard & Poor's. They pay more than Treasury bonds but have relatively low default risk. Duration matters. Duration measures how sensitive a bond's price is to interest rate changes. A bond with duration of 5 will decline approximately 5% if rates rise 1%. Keep duration in the 3 to 7 year range to balance yield and price stability. For the dividend stock portion, quality is paramount. I look for companies with at least 20 years of consecutive dividend increases. This demonstrates commitment to shareholders and ability to grow dividends through various economic conditions. Payout ratios should be conservative, below 60% of earnings. This provides cushion to maintain dividends during temporary earnings declines. Balance sheets should be strong with manageable debt. Highly leveraged companies are more likely to cut dividends during stress. Business models should be durable with consistent demand, consumer staples, healthcare, utilities. These sectors tend to be more stable than cyclical industries. Examples of companies that meet these criteria include Johnson & Johnson, Procter & Gamble, Coca-Cola, PepsiCo, and similar blue-chip dividend growers. A portfolio of 15 to 20 such companies provides diversification while maintaining quality. The growth portfolio, bucket 3, should be broadly diversified and low cost. A total stock market index fund provides exposure to thousands of companies across all sectors and sizes. An international stock index fund adds global diversification. Do not try to pick winners in the growth portfolio. Do not chase hot sectors or trendy stocks. Own the entire market and let it compound over time. The growth portfolio will be volatile. In a bad year, it might decline 25% or more. In a good year, it might gain 30%. Over long periods, stocks have returned around 10% annually. Because your essentials are covered by the income floor and your near-term needs are covered by buckets 1 and 2, you can ride out the volatility in bucket 3. Time is on your side. On step 4, creating your decision framework. Let me provide more specific examples. Here is a sample decision framework you could adapt. Market decline protocol. If stocks decline more than 15% from their peak, I will stop all discretionary withdrawals from the growth portfolio. I will draw exclusively from the liquidity reserve. If the liquidity reserve falls below 1 year of discretionary spending, I will reduce discretionary expenses by 25%. I will not sell any growth holdings until stocks recover to within 10% of their previous peak. Market recovery protocol. After any decline exceeding 15%. Once stocks recover to within 10% of their previous peak, I will restore normal discretionary spending levels and begin refilling the liquidity reserve from excess income. Annual rebalancing protocol on December 1st. Each year, I will review my portfolio allocation. If any bucket differs from its target by more than 5 percentage points, I will rebalance by selling the overweight bucket and buying the underweight bucket. I will execute rebalancing trades within 30 days. Major expense protocol for unexpected expenses under $5,000. I will use the liquidity reserve for expenses between $5,000 and $25,000. I will first use the liquidity reserve, then sell income portfolio holdings if needed. For expenses exceeding $25,000, I will consult with my financial advisor before taking action. Annual review protocol. Each January, I will recalculate my essential expenses and compare them to my income floor. I will review my portfolio structure and rebalance if needed. I will update my decision framework if my circumstances have changed significantly. These protocols are specific enough to guide action, but flexible enough to accommodate varying circumstances. The key is committing to them in advance, before the stress of an actual crisis clouds your judgment. Let me also discuss the role of professional help in implementing this plan. You can implement the 4-step plan entirely on your own. If you have the knowledge, discipline, and time. The concepts are not complicated. The investments are straightforward. The execution is manageable. But many retirees benefit from professional guidance. A fee-only financial advisor who acts as a fiduciary can help you calculate your income need, structure your income floor, build your portfolio, and create your decision framework. The key phrase is fee-only fiduciary. Fee-only means the advisor is paid directly by you, not through commissions on products. Fiduciary means the advisor is legally obligated to act in your best interest. Advisors who earn commissions have inherent conflicts of interest. The products that pay them the most may not be the products that are best for you. Fee-only fiduciaries avoid this conflict. Expect to pay between 0.5% and 1% of assets annually for comprehensive financial planning, or a flat fee ranging from $2,000 to $10,000 per year, depending on complexity. This cost is meaningful, but may be worthwhile if it helps you avoid expensive mistakes. Panic selling during a market decline can easily cost 5 or 10% of your portfolio, far more than years of advisory fees. If you use an advisor, remain engaged. Understand your plan. Ask questions. The advisor is there to help you implement your plan, not to make decisions without your understanding or consent. Let me address the topic of Social Security optimization in more detail, because it is so important for most retirees. The decision of when to claim Social Security has profound implications for your retirement income. For someone with a full retirement age of 67, claiming at 62 reduces benefits by 30%. Claiming at 70 increases benefits by 24% compared to full retirement age. The difference between claiming at 62 versus 70 is approximately 76%. That is enormous. For a married couple, the optimization becomes more complex. Spousal benefits, survivor benefits, and the interplay between two claiming decisions create many possible strategies. In general, the higher earning spouse should delay claiming as long as possible, ideally to 70. This maximizes the survivor benefit, which is crucial if the higher earner dies first. The lower earning spouse has more flexibility. They might claim earlier to provide household income while the higher earner delays. If you have significant Social Security benefits at stake, consider consulting with a Social Security optimization specialist. The analysis is complex, but the potential benefit is substantial. Let me also discuss the emotional challenges of retirement income planning. Transitioning from accumulation to decumulation is psychologically difficult. For decades, you saved and invested. You watched your portfolio grow. Growth was good, decline was bad. In retirement, you start spending what you accumulated, watching your portfolio balance decline. Even when that decline is planned and sustainable, feels wrong. You have spent a lifetime associating portfolio decline with failure. This psychological challenge causes many retirees to underspend. They live more frugally than necessary because they cannot overcome the discomfort of drawing down assets. They miss opportunities for enjoyment that their savings could easily fund. The 4-step plan helps with this psychological challenge. When your income floor covers your essentials, drawing from your portfolio feels less threatening. Your basics are secure regardless of what happens to your investments. The 3-bucket structure also helps. You draw from the liquidity reserve, which is designed to be spent. The income portfolio generates income for spending. Only the growth portfolio is meant to compound over time. Framing matters. You are not drawing down assets, you are spending income from assets designed to provide income. That mental shift can make decumulation feel less threatening. Finally, let me talk about adaptability. The 4-step plan is a framework, not a rigid prescription. Your circumstances will change over time. Health changes, family circumstances change, market conditions change, tax laws change. Review your plan annually and adjust as needed. Your income floor gap might close as Social Security increases with inflation. Your risk tolerance might decrease as you age. Your discretionary spending might decline as you become less active. The framework remains constant even as the details evolve. You always need to know your income need. You always need an income floor covering essentials. You always need a sustainable portfolio structure. You always need a decision framework. The specific numbers and allocations will change. The underlying principles do not. Retirement success over 25 or 30 years requires this kind of adaptability. The world in 20 years will be different from today in ways we cannot predict. A robust framework that can accommodate change is more valuable than a precise plan that breaks when assumptions prove wrong. That is the four-step plan for retirement success. Calculate your true income need. Build your income floor. Structure your investment portfolio for sustainability. Create your decision framework. It is simple but not easy. It requires effort, discipline, and ongoing attention. But it works. It provides the financial and psychological security that makes retirement enjoyable rather than anxious. You have worked hard to reach this stage of life. You deserve a retirement that is secure, comfortable, and fulfilling. The four-step plan can help you achieve that. Start today. Your future self will thank you.